Most retirees believe the greatest financial danger is running out of money too slowly, not losing it all at once. They trust pensions, banks, advisors, and systems that have existed longer than their own careers. Yet again and again, millions quietly disappear from people who did everything right. The mystery is not that retirees lose money, but how losses occur inside institutions designed to protect them, while warning signs remain invisible until it is too late. For decades, retirement planning has been sold as a solved problem. Work steadily, save consistently, invest conservatively, and rely on systems engineered by experts. This promise shaped entire generations. It created confidence that retirement was not a gamble but a contract. What few retirees realize is that the systems they trust operate on incentives, assumptions, and fragilities that shift long before the damage becomes visible. To understand how this happens, we must step back to the origins of modern retirement systems. After World War II, governments and corporations faced a new challenge: how to support aging populations without extended family structures. Pensions emerged as the solution, pooling worker contributions and investing them for decades. The model worked as long as growth was steady and demographics were favorable. Banks, insurance companies, and asset managers grew alongside these pensions, positioning themselves as custodians of safety. Regulations reinforced trust. Logos, offices, and advisors created familiarity. Retirees were not speculators, they were participants in a system that promised predictability. The assumption was simple: large institutions could not afford to fail the people who depended on them. As markets expanded in the 1970s and 1980s, retirement savings shifted from defined benefit pensions to defined contribution plans. Responsibility quietly moved from institutions to individuals, but the illusion of protection remained. Retirees still trusted the same intermediaries, even though the risk structure had changed completely. Market volatility was now personal, not pooled. This shift created the first crack. Investment products became more complex to chase returns in a slower growth world. Fees were buried, risks were abstracted, and performance was reported selectively. Advisors were no longer paid primarily for prudence but for product placement. Retirees did not notice because the system still appeared stable. The rise phase of this story is deceptive because nothing seems broken. Account balances rise, statements arrive on time, and advisors speak confidently. Trust deepens through repetition. Retirees equate familiarity with safety, assuming that longevity equals reliability. Meanwhile, internal pressures grow as institutions stretch for yield in a low-interest environment. The breaking point often arrives quietly. It may be a market downturn, a liquidity crunch, or a regulatory loophole exploited too aggressively. For retirees, losses do not appear as dramatic crashes at first. They show up as frozen accounts, delayed payments, or temporary adjustments. Language softens the reality while damage compounds. Consider how exposure builds over time. Retirement portfolios are frequently overconcentrated in a narrow set of assets because they are labeled conservative. Bonds, annuities, real estate funds, and stable value products appear safe individually, but become fragile together. When interest rates shift or credit markets tighten, correlations spike unexpectedly. At this moment, retirees discover that guarantees often depend on counterparties, not certainty. Pensions rely on funding assumptions. Annuities rely on insurer solvency. Banks rely on asset liquidity. None of these are absolute. They are conditional promises, vulnerable to systemic stress. The fallout phase is where trust collapses. Retirees realize that losses are not temporary but permanent. Recovery time no longer exists because employment income has ended. Unlike younger investors, retirees cannot wait decades for markets to rebound. The emotional impact is as severe as the financial one. Many retirees describe the same experience: confusion followed by disbelief. Advisors stop returning calls. Institutions issue formal letters filled with legal language. Responsibility becomes fragmented. No single actor claims fault because the system itself is the failure. Accountability dissolves into process. Failed fixes often follow. Governments step in with partial bailouts, caps, or restructuring plans. These interventions stabilize institutions, not individuals. Retirees may recover a fraction of their losses, but rarely their original security. Trust is publicly restored while privately destroyed. History offers repeated examples: pension underfunding crises, insurance company collapses, bank failures, and MIS-sold products all follow similar patterns. Each time, retirees are told the situation is unique. Each time, the root causes remain unchanged: misaligned incentives, opaque risk, and delayed transparency. What makes these failures especially damaging is timing. Losses often occur during periods when retirees are most vulnerable to inflation, healthcare costs, and longevity risk. The system fails precisely when protection is needed most. This is not coincidence, but consequence. Modern parallels are even more concerning. Today's retirees face algorithmic trading, leveraged funds, private credit markets, and increasingly interconnected financial institutions. Products are marketed as safer through diversification, yet systemic risk is higher than ever. Complexity has replaced simplicity without reducing danger. Recent data shows that retirement portfolios are more exposed to market volatility than at any point in the past 40 years. At the same time, average retirement durations have increased, magnifying the impact of early losses. A 10% decline at age 30 is recoverable. At age 70, it is devastating. The repeating pattern is clear. Systems expand, trust deepens, risks accumulate invisibly, and failure is revealed only after exposure becomes irreversible. Retirees are not reckless. They are compliant participants in structures designed to obscure fragility until accountability no longer matters. This raises a difficult question: why do people continue to trust systems that have repeatedly failed others before them? The answer lies in cognitive comfort. Delegating responsibility reduces anxiety. Trusting institutions allows individuals to avoid confronting uncertainty directly. Another factor is narrative control. Financial systems are framed as technical and inaccessible. Retirees are discouraged from asking foundational questions. Expertise becomes a shield against scrutiny. When losses occur, complexity is used to explain away consequences. Yet the most uncomfortable truth is that stability itself can be misleading. Long periods without visible failure encourage complacency. Systems appear strongest right before they break. Retirees mistake silence for safety, not realizing that risk is accumulating quietly beneath the surface. This story is not about villainy, it is about structure. Institutions respond rationally to incentives. Regulators react after damage is done. Retirees, meanwhile, operate under outdated assumptions. The gap between expectation and reality widens until collapse becomes unavoidable. There are lessons hidden inside these losses, but only if they are examined honestly. The first is that trust must be continuously re-earned, not inherited. Longevity alone is not proof of safety. Systems must be evaluated based on incentives, transparency, and resilience. The second takeaway is that diversification of institutions matters as much as diversification of assets. Relying on a single pension, insurer, or advisor concentrates risk. Redundancy is not inefficiency, it is protection against systemic failure. The third is that retirees must understand where guarantees end. Every promise has a dependency. Knowing who ultimately bears risk is essential. If that answer is unclear, the guarantee is weaker than it appears. The warning is simple but uncomfortable. Retirement security is not a destination reached once and protected forever. It is a dynamic exposure to systems that change faster than trust adjusts. Ignoring that reality does not make it safer. The open question is whether future retirees will learn from past failures or repeat them under new names and technologies. The systems are evolving, but the incentives remain familiar. History suggests repetition, unless behavior changes. If this story made you reconsider assumptions you have always accepted, that discomfort is valuable. Understanding how trusted systems fail is the first step toward protecting yourself from repeating the same outcome. Stay curious, stay skeptical, and do not confuse reassurance with resilience. If you want more deep, cause and effect breakdowns like this, consider subscribing, sharing this video with someone planning retirement, and continuing the conversation below. The more these patterns are understood, the harder they become to repeat.